So on Thursday, Nvidia overtook Apple briefly to become the second most valuable company in the world, briefly exceeding 3 trillion in market cap, slightly behind Microsoft. And on Friday, Nvidia announced their 10-for-1 stock split. So what's next? Do we expect Nvidia to continue to grow and boom, or is a crash coming soon? Well, let's find out more in this video. Now, in full disclosure, Nvidia is currently the 5th largest position in my portfolio. And if you read my post recently on my social media pages, you can read it on my Facebook page, my LinkedIn page, my Twitter page, my Threads page. I shared a history of my shareholdings of Nvidia. So as you guys know, I first bought Nvidia in late 2022 at $150, and I later sold all my shares at $380. And after I sold all my shares, and the reason I sold my shares was at that time, I thought that Nvidia was expensive, which it was, because my intrinsic value was only $200. So at $380, I thought, okay, expensive, let's sell it. And I sold it using the covered call options, right? But once I sold it, I started to revalue the business, and I found that the intrinsic value had actually increased from $200 to now, close to $400. So once I realized that, I said, okay, I'm gonna buy the shares back. So I bought all my shares back at various prices, but at an average of about $490. So at that time, a couple of my students and my subscribers were a bit concerned. They said, Adam, we sold our shares at $380. Now you're buying it back at $490? Are you crazy? How can you buy it back at a higher price than what you sold it for? And that's perfectly normal. So one of the things that you can understand as an investor is that the intrinsic value of a business is not static. It changes, okay? So if you've got a lousy business, the intrinsic value can decline over time. The business becomes less and less valuable, okay? But if you've got a business that's growing in terms of the revenue, the free cash flow, the market, the competitive advantage, then its intrinsic value will keep increasing. That's why it's very important to keep on constantly revaluing the business. So once I revalued the business, I found that, hey, Nvidia's valuation has increased. And so because of that, I'm going to buy the shares back, even though I buy it back at a higher price. So that's a very important lesson to learn. Never let past prices affect you psychologically. You got to ask, what is the business worth today? And if you think that the share price is below today's value or near the value, and you think the value is gonna grow, there's nothing wrong with buying the shares back. So that's what I did, right? So I bought the shares back at about an average of $490, and of course the share price continued to go up. And Nvidia is a very unique company where every time they announce their new earnings report, their revenue and free cash flow increases significantly by a few 100%. So I've got to keep revaluing it. Right? So when people say, Adam, at that time you said Nvidia is expensive, how can you now say it's cheap? Well, you got to understand that, again, a business keeps evolving. So you got to be flexible to revalue the business, whether it's going to be higher or lower. And if you find that the intrinsic value has increased significantly and the business continues to grow, then you got to be able to buy the shares back. Now, on Thursday, Nvidia hit a high of $1,255 per share. And then on Friday, it was at about $1,209 per share. So that's how it closed on Friday. After the market closed, Nvidia did a 10-for-1 share split. So that essentially means that every share of Nvidia splits into 10 smaller shares. So if you own one share of Nvidia on Friday, you will notice now in your account, every one share you own, now you've got 10 shares. But of course, the share price divides by 10, okay? So now you can see that the charts that you're looking at, they adjust for the share split. So now each Nvidia share divides by 10. So it's now $120.89 per share based on Friday's closed. And the number of shares outstanding increases by 10 times. Now, the reason a company does a share split is to make the shares look cheaper and more attractive, because many people may think, I can't afford to buy $1,000 stock, but hey, I can buy $100 stock, right? But remember that essentially, when the company does a share split, it doesn't change the intrinsic value of the whole business. It's the same business, so the intrinsic value just divides by 10. So based on this, what is my latest valuation of NVIDIA? So I use a discounted free cash flow valuation method where I project all the future free cash flow and discount it to present value, adding the current assets and short-term investments plus deducting the short and long-term debt. So I usually have two valuations, a base case and a more pessimistic valuation. So I've got a valuation range. And so this is my latest valuation of NVIDIA. So my base case valuation is based on, well, you can see the last 12 months, they did 39 billion in free cash flow. They've got total debt of 9.7 billion, cash and short-term investments of 31 billion. And so this is, the free cash flow they have right now. So I've got to project the growth of their free cash flow. And for the next 5 years, for the base case, I'm using a growth rate of 40.74%. Now, where do I get this number from? So what I do is I go to all the different websites where various analysts that study the business, they assign different growth rates, and I take an average of all the different websites. So for example, if I go to Finviz, on Finviz, you can see for NVIDIA, the next 5 years, the projected growth rate is 46% per year for the next 5 years. So that's on Finviz. So that's one opinion, right? Then I go to another website called Yahoo Finance, and the next 5 years, their projected growth rate for NVIDIA is 46.53% as well. Then I go to Zacks, and their projected growth rate is 36.69%. So I go to various websites. Some of them are free, some of them I pay a subscription. And just to show you, from the the 4 main sites I go to, Capital IQ, 33% projected growth rate, Finviz, 46%, Zacks, 36%, Guru Focus, 46%. I take an average of the 4 different consensus analyst projections, and I get an average of 40.74%. So that's how I get this 40.74% growth rate. Now again, I don't just trust these growth rates blindly. I do a deep dive on the business to understand the products. I listen to the CEO's presentations, their earnings call transcript, and then I will add my own opinion to the growth rate as well. And so I do all that on top of just looking at this, but that's beyond the scope of this video, right? And then for the following 5 years, I usually put a cap of 15%. And for the last 10 years, I just put a terminal growth rate of 4%. And I use an 8.1% discount rate based on the cost of equity. Now, so before the share split, NVIDIA had 2,462 million shares outstanding. So before the share split, my intrinsic value was $1,221 before the share split. Now that they did the share split, the number of shares increases by 10 times, right? So I've got to now increase this to 24620. 24620. Boom. And straight away, the intrinsic value divides by 10. So now the new intrinsic value is $122. And of course, on Monday, when the market opens, the share price will divide by 10 as well. So based on Friday's closing share price, if it opens at Friday's close, that will be divided by 10. That will be 120.9. Which means that at the current share price, NVIDIA is selling at the fair value. It's not expensive. It is not cheap. It's selling at a fair value. Now, again, this is based on the assumption that NVIDIA can grow their free cash flow at 40% a year for the next 5 years. So can they really do that? Or are the analysts on drugs, right? So later I'm going to talk a bit about my analysis of NVIDIA's total addressable market, their products, their services, and whether this is realistic or is this, pie in the sky, right? You've got to always back up your research. Now, this is my base case valuation. I always have a pessimistic valuation. So for my pessimistic valuation, everything is the same. 24620 and this 120.9, except for the growth rate, I take the lowest growth rate among all the websites. So recall these were all the different growth rates that I got an average of 40%. Okay, by the way, the last 5 years, NVIDIA was growing at 48% for the last 5 years, right? So if I take the lowest growth rate from Capital IQ, that's 33.2%. If I use that lowest growth rate, that gives me an intrinsic value of $94. All right. So in other words, if you look at my chart, you can see that my base case valuation is 122, but my more pessimistic conservative valuation is $94. So this is what I call my valuation range. So when you value a business, there's always a range, right? And ideally, you want to buy the shares when the share price is within the range, or better still, is below the range. Then you get a big discount, you get a bigger margin of safety. So after growing at a compounded annual growth rate of 48% in the last 5 years, can NVIDIA realistically grow another 33% to 40% in the next 5 years? I'm not here to convince you of anything. I'm here to show you the facts and you make your own decision. And if you think that they can, then it's a good investment. If you think that they can't, then it's a lousy investment. So again, I'm not here to recommend you buy or sell. I'm here to just share with you the facts, right? So the first thing to understand is that what does NVIDIA do? When I hear people say that, oh, semiconductors are very cyclical, that this growth is not sustainable, I think a lot of these people, they don't know what NVIDIA does. Now, NVIDIA used to be a GPU chip maker. They make graphics processing units for gaming solutions, right? But NVIDIA today is a totally different business than what it was 2 to 3 years ago. In the words of Jensen Huang, NVIDIA now produces AI factories, AI computing platforms that consist not just of hardware, but hardware plus software plus networking solutions. So if you ask me, AMD and Intel, they are not even competitors because they don't have this full integrated platform which NVIDIA is now offering. So this chart shows the entire product and services offering of NVIDIA. It consists of 3 main levels. So the first level that you see here would be their hardware, which again is made up of 5 things. First, their GPUs, or I call them AI chips, the CPUs, their DPUs or data processing unit, their chip-to-chip switches, which is NVLink Spine, and their rack-to-rack networking solutions, which is InfiniBand or Spectrum-X. Now, to me, the most important thing about investing in a business is that the business must have a sustainable competitive advantage and economic moat where competitors cannot easily take away their market share or take away their customers. So what gives NVIDIA this moat? It's not just their very high-performing GPUs, because again, AMD or Intel or even Google or Meta, they could create their own GPUs, right? And compete with NVIDIA. So that is not their moat. The moat of NVIDIA, or what makes them special and unique versus their competition, is their CUDA software ecosystem and acceleration libraries. So CUDA is a very powerful programming platform that developers use to leverage on NVIDIA's architecture. First, the Hopper architecture, the Blackwell architecture, and the coming Rubin architecture to develop and to train AI models. And this is a very powerful ecosystem that creates very high customer and developer switching cost. So that means once developers write the codes on NVIDIA's CUDA's ecosystem, they are very unlikely to want to use another platform from AMD or from Intel, because if they do that, they have to rewrite all the codes. So by doing this, it locks them into the ecosystem, just like how Apple locks in Apple users to their ecosystem, or how Microsoft locks in Microsoft users to their ecosystem. So it is combining the software solutions with the hardware solutions that allows accelerated computing applications across different markets, where you can apply it to pharmaceuticals, biotech like gene sequencing, automotive driving, as well as finance. Now, on top of that is level 3, where NVIDIA has got this whole suite of software applications. For example, Isaac, which is used to train and control robots. There'll be a huge market, huge total addressable market. You've got Drive that's used to train cars for autonomous driving. You have got Avatar that's used to train avatars in gaming. So again, NVIDIA is more than just a gaming company. You can see that they've expanded into huge number of markets beyond just creating data centers. Now, before I invest in a business, there are two things I want to ensure. Number one, that there's a huge growth runway. There's a huge total addressable market to be captured. So I know that there's a lot of growth left. Number two, I want to make sure the company has a strong moat that can't easily be disrupted by competition. So the first thing I talked about is about the moat of NVIDIA. Now the next question is there a lot more growth ahead? I think so. So if you listen to Jensen Huang's recent presentation, this is what he said. He said, the days of millions of GPU data centers are coming. Now, currently, if you look at most data centers, they are in the thousands. They are in the thousands, tens of thousands of GPUs right now. By next year, we're looking at hundreds of thousands of GPUs per data center in order to execute all this AI in the industry, right? And by 2026, we're looking at millions of GPUs per data center. So what does that mean? That means if you think that NVIDIA has sold a lot of so-called GPUs, data center GPUs, it's nothing. It's only the beginning. In the future, almost every interaction you have with the internet or with a computer will have a generative AI running in the cloud somewhere. So as you guys know, for example, Apple is now integrating AI into all their devices. So in the near future, in just a few months, your iPhone, your Mac, your iPad will be all running AI in the background. Now to do this, you need millions of GPUs to execute from the data centers. And again, who's going to provide these GPUs and these platforms? NVIDIA. They've got over 80% market share. So generative AI will be working with you in this so-called AI revolution, interacting with you, generating videos or images or text, or maybe a digital human. And again, these are the words of Jensen Huang, not my words, right? So if you're interacting with your computer almost all the time, and there's always a generative AI connected to that, again, you need a tremendous amount of accelerated computing power for that to happen. And NVIDIA, again, will be the main provider of the hardware and software to execute that. To give you an idea, Microsoft is now looking to triple its GPU supply to 1.8 million GPUs this year alone because of their high demand for Azure, right? Meta has disclosed its GPU orders with 350,000 new orders this year. And X, which is run by Elon Musk, they are looking to order an additional 300,000 Blackwell 200 GPUs this year. And again, this is just this year. So by 2026, it's going to be millions of GPUs, right? So based on this, industry analysts are projecting a compounded annual growth rate for AI accelerators of 36.6% to 37.4% compounded annual growth rate to the end of the decade, which means the next 6 years. So based on this, we're looking at roughly an NVIDIA revenue of 661 billion by the end of the decade, based on this projection, right? So right now, NVIDIA's revenue is 80 billion. So 661 divided by 80, we're looking at 8 times. So whatever revenue NVIDIA is doing now, we're looking at 8 times that in the next 6 years, right? Another way to look at it is based on this chart that was also shown during the NVIDIA presentation. Their total opportunity across NVIDIA AI Enterprise Software, Omniverse Enterprise Software, chips and systems, gaming, which was previously their main business, right? And automotive accounts for a total addressable market of 1 trillion. Now, currently, like I said, Nvidia is doing about 80 million in revenue. Their net profit is 42 billion. Their net profit margin is 53%. So their market cap is 3 trillion. And their market share is now 80%. So let's say the next 3 to 6 years, they are able to capture 60% market share. I'm assuming their market share is going to fall, right? From 80%, let's say their market share drops to 60%. So 60% of a trillion would be 600 billion in revenue. And I'm going to assume that over time, their margins are going to decrease from 53% to 45%. Okay, I'm being very conservative over here, right? So 45% net profit margin out of 600 billion revenue gives you a net income of 270 billion. And if you take a 25 times multiple, that gives us a market cap of 6.75 trillion for Nvidia in the next 5 to 6 years. So in other words, based on this, we have got a growth of 125% at current levels. So the question is, can Nvidia double in share price from today? I think it is very possible if you believe that we are at the beginning of an AI revolution, which I do believe in. But of course, if you don't believe in it, then of course it is not possible. And that's why I keep saying that I'm not here to convince you of anything. I'm here to state the facts and you make your own decisions. So am I going to buy more Nvidia shares at this level? No, I'm not. Well, one reason is because I already have a full allocation and it's really the 5th biggest position in my portfolio. So I'm not adding more shares at this level. Now, if it gets a lot cheaper, then I may add a bit more. As mentioned, my intrinsic value of Nvidia is a base case valuation of $122. So the current price is at fair value, right? But I've got a more conservative valuation of $94. So that's my valuation range. And ideally, as an investor, I want to buy it when the share price is below the valuation. And the lower the share price is compared to the valuation, the bigger the margin of safety that I have. Now, what if I didn't own any Nvidia right now? Would I start adding a bit now? Again, I'll wait because technically, based on the charts, you can see it's a bit overextended. Remember that nothing goes up in a straight line. Although I believe that Nvidia will double in the next 5 to 6 years, but it won't go up every day, every week, every month, every year, right? You go through wave up, wave down, wave up, wave down. There will be a lot of ups and downs along the way. And it's when it retraces wave down, that's when I get excited to add more shares. Or if I'm an investor, that's when I want to start buying for the very first time. And if you look at the price action, you can see, again, you got a wave up, wave down, 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 wave up, right? So right now it's waving up. And usually I don't like to chase something which is waving up, right? I like to wait for it to, wave down and then buy when it retraces to a level of support. So for every stock, I identify at least 3 to 4 levels of support where I would add shares in tranches, 3 to 4 tranches, so I average in my position. We call that dollar cost averaging. Because I never admit that I can pick the absolute bottom. Sometimes you may pick the absolute bottom, but more often than not, no one knows where the bottom is. So as long as we buy below valuation, and if it goes even lower, we keep on adding more to bring down our average cost. Eventually, when the share price rebounds, you're going to get really good returns. So what I do for all my subscribers in the Ultimate Investors Playbook is every month I will update the intrinsic value of all my stocks which I think are great businesses, and I also update these support levels. And to share with you in this video, my support levels for Nvidia would be at $96, 87, 73, and 62. So in other words, if I were wanting to start buying Nvidia shares, I would like to wait for a retracement to at least the $96 level where I would then start adding. Now, since I already have quite a number of Nvidia shares, I'll probably wait for it to retrace down to a second or third, or if I'm lucky, the fourth support level where I can buy at half price, 50% discount, I'll love that to happen. Now, am I predicting it's going to go down? Of course not. No one can predict in the short term where the price is going. So to me, it's a win-win. If the price keeps going up, I can't buy more shares, but it's fine because my portfolio keeps growing in market value, right? But if the next few months or the next 1 or 2 years, Nvidia drops 50%, it's also good news because I get a chance to buy more at 30-50% discount so that in the next few years, my portfolio will compound even more, right? So when you have the right mindset as an investor, it's always a win-win scenario. Market goes down in the short term, you win. Market goes up, you also win, right? As long as you hold high quality businesses. Nvidia just split their shares. So historically, when a stock splits their shares, how does the price usually perform in the next 3, 6, 12 months? Well, historically, research has found that if you look at the entire market in general, the stock price tends to outperform after a stock split. So over here, you can see this was a research done by FactSet. And this is based on the 500 stocks in the S&P that had a stock split of at least 2-for-1. And this is between 2012 and 2020. So in other words, the last 8 years, what they found was that when a stock split, before the split, you would get a outperformance. This is the amount of outperformance above the S&P 500. So in other words, most stocks, before they split, they will get a return of 2.8% above the index. And right after the split, you will see a bit of a pullback initially, right after the split, within the next 30 days, right? But then 12 months later, about 360 days after the split, generally the stock will outperform the market by about 5.5%. So generally, stock splits are bullish for a stock. Now again, not always, because it depends on many other factors. Depends on, is the whole market in a bull market, is in a bear market, the company, is it generating earnings growth, is the earnings declining? So there are many other variables to think about as well. So there's no guarantee. So I'll give you a few examples of some recent stock splits, right? So Apple did a stock split 4-for-1 on August 28, 2020. Right? And this was during a bull market. So you can see before the stock split, Apple rallied very strongly. Right after the stock split, we had a drop. Okay? And then 12 months later, Apple was up 20% from the time of the split. So that was Apple. Next, we look at Amazon. Amazon, they did a split on June 6, 2022. And bear in mind that that was during a bear market, right? That was during a bear market, and later it turned into a bull market in the last 6 months. So half bear, half bull. So what happened? You can see before the split, Amazon dropped. Well, everything dropped, okay? After the split, Amazon went up, then dropped more, and then went up again. So in the end, after 12 months, Amazon gained 2% after the split. But again, it's because of the bear market to the bull market scenario. Next, we have got Alphabet. They did a split on 15 July 2022, again during the bear market. All right. Before the split, which is this blue line, it dropped. After the split, it went up, dropped down again, and by the end of 12 months, it was up 12% post-split. Next example, Tesla. So Tesla did a split on the 25th of August, again during a bear market. And to make things worse, Tesla, just like Amazon at the time, was reporting a slowdown in their earnings and free cash flow. And in Tesla's case, revenue dropping and market share, they're losing market share, earnings are dropping. So a lot of negative fundamentals in the stock itself. So you can see after the split, it went down, up, and then dropped. After 12 months, Tesla was down 19% after the split. So it's not because of the split, it's because, again, of the challenging industry that Tesla still is in, okay? Finally, Nvidia, their last split was 3 years ago on the 20th of July. And before the split, there was a rally. Just before the split, a bit of a pullback. Right after the split, boom, look at that. But then it fell back. Why? Because the bear market started. All right. And 12 months later, Nvidia was down 5.7%. Not because of the company, because the whole market went to a bear market because the Fed raised interest rates aggressively. All right. So in other words, looking at all these things, is there a pattern? The answer is no. There's no pattern, right? So sometimes after a split, it goes up. Sometimes it goes down. Sometimes 12 months later, it's up, it's down. So it depends on the market sentiment. It depends on the individual company. So that's why I keep telling people that never make investment decisions based on whether it's before a split or after the split. At the end of the day, your investment decisions are based on the business itself. Is the business growing? Their free cash flow, their revenue, is it undervalued? That's more important. Now, let me end off this presentation with a bit of a scary slide. So what I did was I looked back at all the previous times that Nvidia split their stock. Now, Nvidia has split their stock 5 times previously before the latest split on Friday. So the first time they split was 27 June 2000, right there on this blue line, all right? And then they did a split on 17 September 2001. And what happened after that? We had the dot-com crash, right? Everything collapsed. Again, it's not Nvidia's fault. It was the dot-com bubble that burst, all right? And then the third split was April 06. And then the stock ran up for a year. And they split again on September 07. And what happened right after that? The great subprime mortgage crisis, everything collapsed. Again, not Nvidia's fault, just bad timing, right? And their fourth split was on 20th July 2021, right there. What happened the stock rose for a few months, and then we had the bear market because of the Fed raising rates very fast because of super high inflation, and we went down again. So now we're having another split right here. So if you look back at it, no, we are not saying that Nvidia's split caused the market to crash. It's like kind of like every time you wash a car, it rains, right? That's bad luck, but it doesn't mean you're washing the car caused the rain. So now you're washing the car again. Is it going to crash? All right. So the brain likes to look for patterns. And if you look at the pattern, you may think, hey, it's going to crash, right? But seriously speaking, we don't know. We can't predict short-term price movements. But all I can say is this, that the dot-com bubble at the time that burst is very different from this AI rally that we're seeing right here. I showed this chart recently on my socials that if you're old enough to remember, during the dot-com bubble, the stock market was going up, whereas most companies were not making money. Their earnings were nowhere near the stock price. So in other words, it was a bubble not supported by earnings, right? But in today's market, yes, the stock market has been going up, the one in blue, but the earnings of the company have actually been increasing even more than the stock price. So in other words, today's market is not built on froth or hype, maybe except GameStop, right? But the majority of great businesses are being supported by good earnings and all that. So we are not in the same situation as in the 2001, yeah? And during the great financial crisis, what caused the crash was a lot of the financial institutions, the banks were highly leveraged. Today, most banks are not that highly leveraged. They have a lot of cash on their balance sheets. They have got very strong credit ratings. So we are not in those same scenarios. And are we in the scenario of 2021 with super high inflation and Fed going to raise rates aggressively? No as well. All right. So I wouldn't worry too much about this scary chart. But at the same time, I will not chase Nvidia at today's share price. I won't be surprised if we do get a healthy pullback or wave down right after the stock split. And if we do get a pullback nearer to the support levels where it begins to be more attractively valued, then that could be a great entry point for investors into Nvidia. Hope you enjoyed this and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.